In this chapter, we're going to be looking at Chapter 12, talking about stocks. And stocks are really kind of different and can be confusing for a lot of folks. They're the learning objectives, understanding what are some of the features of the various types of stocks, how to evaluate them, things like that. One of the issues that a lot of folks have is, where do you get the information? Okay, and what does it really mean as far as some of the information that you might get? Well, let's go over some terms and things like that. First of all, you have common stock. In other words, you are buying stock in a particular company. You are now a part owner in that company. And what the company does is they use that for financing. In other words, they'll buy more equipment and buy more inventory and things like this. They'll pay their bills with it and that sort of thing. So you are part owner in that. Now, one of the things that you typically expect to be an owner is to get some of the profits back. If you're an owner, you want to get some of the profits. That's dividends. And so what they'll do is they'll pay dividends to share some of the profits that have been coming from doing business. The rest of what they make from that, they plow back into the business, hopefully improving the value of the overall organization. You as a shareholder, as an owner, also have voting rights, okay, to elect the board of directors. The board of directors report to you. You are the boss because you're the owner. And the board of directors represent your interests to the management of the organization. There is risk when you invest in stocks, okay, because you could lose everything. They don't have to pay you back if they go belly up. The key to success is to let it work for you over a long period of time. One of the things that you'll find if you do research as far as what's happened with stocks over a length of time, buying stocks, holding, being a part of the market for a long period of time, you always make money. Long term, you always make money. Now, common stock is the most common form, okay? What they're doing is they're financing the organization. They pay dividends to distribute some of the profits, but they don't have to. And you also have voting rights. One of the things that you'll get from the company is what's called a proxy. A proxy, in other words, what it is a thing that says, okay, here are the things that are being voted on by the board of directors. Do you vote for or against? And so you have an opportunity to have a say in how the company is actually being run. When you're investing in stocks, you're making money in a couple of ways. One is from the dividends. In other words, you buy it, you're getting a portion of the profits. The other way you can make money off of stocks is an increase in value in the stock. So one of the reasons why people buy stock in companies is hoping that the value of the company increases. So you buy it low and then you sell it high. Now, you'll hear some things about dividends. There's a thing called the declaration date. In other words, the board of directors will vote to pay a dividend, and it's typically quarterly. Record date is when you have to have that stock. You're registered on the firm's books where you have that stock and you can receive the dividend. You'll see ex-dividend date. That's the second business day before the record date, okay, begins to trade without the dividend. So in other words, after that record date, after that ex-dividend date, once you buy that stock, you don't get the dividend for that quarter. And then the payment date is when the dividend is actually paid. Now, you can have them send you cash, or what most of us do is take that dividend and buy more shares of stock. Now, you may hear about stock splits. What happens is, let's say that you have a company and the stock is increasing in value and it's going to cost maybe $100 a share. Well, one of the things that you might want to do is make it so that more people can buy more shares of that stock. And you think, okay, a price of maybe $50 a share is more of what we would like. What you'll do is a stock split. In other words, let's say that you are a stockholder, you own 100 shares. Well, they split it 2 for 1. What they do now is they will trade in, you trade in your shares and then you get 200 shares back. In other words, you have now doubled the number of shares. But what that does is that then cuts the value of those shares in half. Before, you had 100 shares worth $100 each. Now you have 200 shares worth $50 each. Same thing. So when you get a stock split, there's no guarantee that you're going to have more value. You just have more shares of stock. And what it does is it splits out the value of the stock. Hopefully, as it goes up, then you're making even more money. Now you may hear about preferred stocks, okay? Preferred stocks are stocks. You still own equity, but it doesn't pay dividends. What it does is it kind of pays interest. You get a guaranteed dividend every quarter with preferred stock. If the company goes belly up, you get your money back first before anything gets distributed to common stock. In other words, it's preferred. Most people buy common stocks. There's not that much in the way of preferred stock that's actually out there. One of the things that will happen is you need to think about, okay, somebody's going to issue some stock. Is this something that I'm really willing to put my money into? You have to think about the risk that goes into buying some of those stocks. There's different types of stocks. So in other words, based on the company's credit rating and what it is that they pay as far as dividends, how solid are they financially, things like this. Blue chips are the bigger corporations that are very stable, very strong financially. Cyclical are companies where the stock price goes up and down based on business cycle or seasons. Defensive stocks tend to be stable. Growth stocks have that potential of increasing in value throughout the year and for over the long term. Income stocks are where they don't increase that much in value, but they pay quite a bit in dividends. So for example, things like utilities. Now you may hear about large cap, mid cap, small cap. Cap is short for capitalization. In other words, the worth of the overall company. Large cap is a company that's worth more than $10 billion as far as their value is concerned. Mid cap between 2 and 10 billion, small cap between 300 million and 2 billion. So that's what when you hear about large cap, mid cap, small cap, that's what that means. You can get all kinds of information on the internet. I typically go out to yahoo.finance to get information as far as what's happening with stocks, what's happening with the market, things like that. When you pull up a particular stock out at yahoo.finance, this is the kind of information that you might get. It might look like this, where it has various prices and information, and it might have some charts and graphs and things like that. What some of this information means. Here's the last price where it was traded. Here's information that's really important. PE ratio. That's the price to earnings ratio. All right. In other words, what's the price of the stock divided by the earnings that they have? All right. And that gives you a ratio. EPS is earnings per share. How much do they earn, bottom line, profit, per share? And then this is the dividend and the yield. So in other words, the amount of dividend is $1.76, which gives you a 2.4% yield as far as the profit is concerned. And so that's some of the information when you pull up some of the price quote information, some of the things that it's showing. It also shows, okay, well, this is the current one. What would it last close at? What has it been trading at for today? For the last year? What kind of range has been going on? What kind of volume? In other words, in this case, almost 5 million shares, things like that. What are the things that determines the price of the stock or the corporate earnings? The more the earnings, the more the price of the stock goes up because it's a much more solid financial company. Earnings per share, as long as earnings per share is going up, then it's saying that that's a very healthy sign as far as the organization is concerned. When you start looking at that price to earnings ratio, the price earnings ratio, PE ratio, greater than 20, that's saying that, okay, there's going to be some investor optimism there. You look at the price, all right, and the price is going up compared to their earnings. Price earnings ratio of less than 20. They're not expecting the earnings to really be as strong as they could be. What you want to do when you're looking at this is do a comparison of the firms in the same industry. In other words, you may have a PE ratio of 18 for one company and another one of 15 in the same for another company, but they're in the same industry. These are things that maybe the 18 may be actually some good optimism there. Dividend yield, in other words, if the dividend yield is going up, then that's a stronger company. And you also want to think about what your total return is going to be. In other words, what kind of dividends are you getting, plus what kind of price appreciation. How much is the value of that stock going up? Now, what are securities exchanges? You buy the stocks on the various exchanges out there. For example, the New York Stock Exchange is a place where members will get together and they will sell and buy stocks. You also have what's called over-the-counter. And you may hear about NASDAQ. NASDAQ is that marketplace where you have over 3,000 different companies that are a part of that. It's basically a computer system that has, okay, here are all the listed stocks and here's who owns some of these things, and you can trade back and forth as far as what those stocks are going to be. Buying, selling, things like that on the NASDAQ. An account executive or a stockbroker is somebody who's actually working in your interest, who may be a member of the New York Stock Exchange, who may be out there and can go out and buy and sell stocks for you. One of the things to think about is, are you going to use a full service firm or a discount firm? Full service firm is for somebody who doesn't really want to mess with doing the research as far as the stocks are concerned. They just want to put their money in there and say, make it the best they possibly can. Discount firms are for those who like to go in and say, okay, I want to buy this stock, I want to sell this stock, that sort of thing. Some of the things to think about and a question to ask, which ones you can use. Kind of be familiar with some of this information. You may hear about market orders, limit orders, and stop loss. In other words, a market order is where you say to your broker, go sell this number of shares of stock, or go buy this number of shares of stock. A limit is basically saying, okay, once the price of a stock gets to a certain point, either buy or sell. Now, one of the things that happens is brokers are going to charge you for making those trades, and so they get commissions on those things, and it depends on the account that you have set up. You could be paying your commission at the purchase or maybe at the sale. All right, so it depends on the firm and the accounts that you set up. One of the things to think about are your strategies. Long-term strategies are basically buy and hold. All right, in other words, okay, I'm going to buy these stocks and I'm just going to sit on them. And the reason for that is because in the long term, stocks are going to go up, and again, depends on the stocks that you buy. Another thing to think about is dividend reinvestment plans. In other words, you get a dividend, what you do is you just buy more stock with it. Now this talks about dollar cost averaging. In other words, you're buying stocks at different stock prices over the time. How are you, what are we actually saying as far as how much do you own? All right. And what they do is they dollar cost average that and this sort of thing. You don't have to know much about that. The dividend reinvestment plan, what you're doing is you're purchasing more stock based on the dividends. That's where you're spending your money on that. And also the fees and the investment amounts and the rules and things like that depend upon the company that you're using and the accounts that you set up. One of the things that you may hear about is buying on margin or selling short. Buying on margin is where you're borrowing the money from a stockbroker to actually purchase more stock. So what you want to do is you're purchasing this stock at a particular, you're borrowing the money and you're purchasing the stock at a certain level, say $100 a share. What you're doing is you're hoping that the stock will then go up to maybe $105 and you pay back the money that you borrowed, and you've made the $5 a share on that stock. Selling short is kind of along the same lines. What you're doing is you're actually borrowing the stock from a stockbroker, and then what you do is you sell it. And you sell it at the particular price. What you're thinking is, okay, the stock value is actually going down. So I have sold it now. Let's say that I borrowed a bunch of shares from my stockbroker, and I sell it for $100. And then what happens is the stock price goes down to maybe 95 or 90. So I wait, and then what I'll do is I'll go in and buy the shares at $90, and then give those shares back to my stockbroker. I've earned $10 a share because of that. That's selling short. You could also think about options. Options are a right to purchase stock, a certain number of shares of stock, at a particular price. For example, a lot of companies will give executives or other employees options as rewards for doing things. The purpose of that is if you continue to work real hard to improve the value of the company, the price of stocks will go up. So let's say that somebody gave you an option to buy 100 shares at $10 a share. And so what you've done is you've held on to those options, and the price of the stock has actually gone up to about $15 a share. So you say, okay, I'm going to exercise my option. So what you do is you buy that 100 shares at $10, and then you immediately turn around and sell it for $15 each. So what you did was you spent $1,000, you bought 100 shares at $10 each. You just sold that 100 shares for $15 each. So you sold it for $1,500. You just made $500. That's where a lot of senior execs actually make their money, is because of the options that they've been given, and then what they do is they exercise those options. So those are some key points as far as the chapter is concerned. If you have questions, give me a call.